Thanks for watching us here at Tax Talk UK, where we talk about all things tax and all other aspects of things that you need to consider or know about when you're self-employed or running your small business. So we're going to have a look at capital allowances on your self-assessment tax return. Before we get on to that, if I could please ask you to take a moment to subscribe to our YouTube channel. That way you will easily be able to refer back to this information if you need to, as well as finding the other content that we have available to help and support you in your self-employment. If you want to be notified as soon as we upload new information, then you should also turn on the notifications. So on to capital allowances then. So specifically the question we were asked to cover was from somebody who has bought a van for their business in the year and was asking where do they put this on their self-assessment tax return. So this of course applies to a whole range of assets that you may have brought for your business and how you go about claiming the expenditure for them. So as we know, we only claim for expenditure that is wholly and exclusively for the use of your for the purpose of your business. So if you buy a large item, something that probably would be expected to last for a good sort of like few years or so, then we would call that an asset and we would refer to it as capital expenditure. So how much do you have to spend? It's a subjective question. So everything that you buy, if you just sort of went and bought a pen, for example, that is still technically it's an asset, it's something that your business owns, but we wouldn't treat it as an asset. We would be expensing that as expenditure and treating it in the normal business expenses section of our self-assessment tax return. So perhaps you might like to consider setting a threshold of maybe sort of 500, maybe £1,000, under which anything under that you just expense, and anything over that that you treat as an asset. But clearly the purchase of a van is capital expenditure, so we wouldn't just be popping that into the business expenses section of our self-assessment tax return. Those of you that are already familiar with submitting your returns would know that once you get past that income and expenditure section, you will get onto the capital allowances, and you will see phrases like capital allowances, annual investment allowance, and such. So this is where you treat your van or whichever asset it is that you're looking at. So there's more than one way to claim the allowance. So typically the audience that we would expect to be watching this video and the cost that you would incur on your asset, it is likely that the amount would qualify for annual investment allowance, but we will put the link in the description to the guidance so that you can actually check if you're not certain whether annual investment allowance is available and is applicable. So if you claim annual investment allowance, by that what we're saying is, okay, here is the profit, I've worked out my income and I've worked out my expenditure, this is the profit of my business, and I want to claim the whole cost of my expenditure for my asset in this year, in the first year that I incurred that expense. And that would lower your tax liability for the year. And the other way is to depreciate the asset, and you would then be claiming a capital allowance. So typically, depending on what the asset is, and again, more links in the description so you can check on the specific asset. And if it's a vehicle, it also does depend on some other things like its emissions and basically how environmentally friendly it is. But if, for example, you are able to depreciate at the standard rate of 18%, you would say, okay, I paid £10,000 for my vehicle, so I'm going to depreciate that, and therefore 18% of 10,000 is £1,800, and that is how much I'm going to claim against my tax liability and against my profit for my tax liability in this year. And then you go into the second year, and your asset now is the 10,000 you originally spent, less the 1,800 you've already claimed, and so then it's 8,200. And so then in the second year you claim 18% of 8,200, and then you take the what's called the net book value into the third year, and so on and so forth. And obviously it would just be the outstanding value, the net book value would just be reducing what you're claiming. So that way you are spreading the benefit of the tax relief over time. And there's quite a few things to consider in which is the right way to treat your capital expenditure. Please don't be too hasty in thinking, yeah, this is great, I can wipe out all my profit and pay no tax this year. Please do consider the long-term effects of what you're doing. So, for example, if claiming an annual investment allowance brings your net profit, your taxable profit below the threshold for tax, then in effect you're wasting some of that expense, because it's not going to all in effect be claimed, because you're reducing your profit to such an amount. Now that obviously won't always be the case. It could be that you claim the annual investment allowance and your taxable profit is still above and beyond your threshold, so you don't have to concern yourself about that aspect. But another thing to consider is the long term and what happens when you dispose of that asset. So when you sell that asset, so in the instance and the example of a van, if you buy the asset and you claim an annual investment allowance, you've claimed the whole cost of that has already been claimed. So then in the future, if you receive anything back for the van when you come, if you're able to sell it, then that will then be income that you will then need to pay tax on. Whereas if you're depreciating it, yes, of course, your van's not going to always be worth what the outstanding net book value is, but it's certainly going to sort of smooth that out. So that is something to consider as well. It's fine as long as you're aware of what of the implications of the choice that you're making. And then another thing to consider that's not really relating to the business, but from you as an individual, is if you are a homeowner and you're looking to become a homeowner, and for any other reasons that your income is going to be assessed against your net profit, you need to bear in mind that if you are a sole trader and self-employed sole trader, and you are providing your income proof for the purposes of having a mortgage, is just one example, then your profit for tax purposes is the figure that they will be looking at. So much as it might be great because it's nice and low that year for tax, it does actually drop your income down, and that can cause you some issues if you're coming to looking to borrow some money. So please do sort of bear that in mind as well. So again, as we always say, this is just an overview, and we would expect, if you're looking at this is something you're doing yourself, that you do actually have a grasp of what we're talking about, and this isn't completely alien. Of course, if you are struggling to get your head around it and you're really not sure, and you've looked at the guidance links direct on gov.uk, and you've watched what we've said, and you're still not sure, then please do consider having some professional help to help you to make sure that what you claim is correct, because of course it can go either way. Obviously you could be claiming short, which will mean that in effect you're paying too much tax, and the extra tax that you're saving could quite easily cover the cost of some professional support, and also obviously gives you the peace of mind. It could go the other way, that you've overclaimed, and yes, you might think, yeah, that's great because I've paid less tax than I need to, but obviously then at some point that is going to potentially be uncovered, and then you're going to think, I thought that year was all sorted, and then you find out actually you didn't pay all the tax, and of course over a compounded number of years underpaying your tax, and then having to backdate it, pay what you've claimed incorrectly, can be very costly. Yeah, so please do take that into account if you are looking to do your own self-assessment tax return, that you are confident that you are doing it correctly. And as I say, links in the description for the things that we've talked about. So hopefully this helps you to understand, if you've brought any larger assets, how you will treat those in your self-assessment tax return. Thank you very much for watching, and as I mentioned, please do take a moment to subscribe to our YouTube channel, and good luck with your business. Thank you. Goodbye.